Chris, we turn to you. You're expecting relatively good things for the regional banks, it sounds like.
Well, good things from a perspective of the banks making money and tangible book value and tangible capital rising. I do think Leslie's on the right track. I think it's going to be a tough quarter from a margin and cost of funds. There's a big reset going on, Kelly, for sure. We think that most banks are going to see higher loan loss provisions, so earnings misses most likely happen because of those two factors. But the reality is the market's looking way beyond the second quarter prints. They're looking into third and fourth quarter where deposit costs continue to rise, but the banks are getting ahead of the problems they have. And what's interesting to me is that we have seen deposits very much stabilize, only down about 0.5% on the Fed data from the end of June through the end of March. And so that's a win. It's happening because banks are paying up for funds. And so we are resetting the cost all around the street on funding, and that's going to come through on margins on the bad side. The flip side will be the loan yields will continue to get better. And I think particularly heading into year end, you'll see a lot more new loans done at 7.5%, 8+% yields. And that's very bullish. So I think margins have an opportunity to stabilize. And we may even see a few portfolios on securities get restructured in Q3. And that's going to help as well in terms of the margin not getting a whole lot worse than what we're going to see in the second and third quarter.
I'm glad you mentioned the loan loss provisions. You know, speaking with one of the most successful regional bank heads, now retired a couple of months ago, and even as all the markets and everyone on the street is all excited about, you know, how great everything looks right now, he was saying he's more cautious. You know, I asked him if he agreed with Sheila Bair that the regional banks are a buy, and he said he wasn't so sure that we hadn't seen the credit cycle turn yet. And to him, it's just a matter of time, and it might not be now, and it might not even be for the rest of this year, but there is a sense that that event is still kind of out there.
Oh, that's 100% accurate. I mean, this is a cycle just like the weather changes. And as we go into 24 and 25, you will see defaults in the industry. Defaults will be a lot worse for office real estate. We all know that and are anticipating that. The time for banks to build reserves is now, to set aside those funds and prepare for the charge-offs that come. I don't think the losses will be that bad because we have a lot less leverage. Leverage is typically 60% on the go backwards basis, and the new loans today are done increasingly at 50% or even less. So credit is scarce. That means the price of credit should go up. And ultimately, I think the credit quality, while it will have bumps and bruises along the way, and we have to reserve for that, it's going to be a lot less than it was 15 years ago, thanks to less leverage and better terms than we had back in 2008, 9, and 10.
Do you agree with the sense that there's going to be a lot of regional bank consolidation, and should we expect this earnings season to be some kind of catalyst for that?
I doubt that we're going to see much consolidation. I think it's really hard for the Fed examiners to approve deals. And I think it's going to be one-off transactions and most likely not this year. I think you may see one or two deals done next year, but most of the bank consolidation is going to be well below $100 billion and a lot of it below $20 and $15 billion. So that's where the consolidation, that's where extra banks are there. And that's, to me, where the money really is on the M&A side. I think that what will happen is business will move out of large banks who pull back and then move to the mid-sized companies who can pick up market share and really thoughtfully do new loans at better terms and better spreads. So that's the play at the moment. And I think a lot of the negativity has been overdone. And I think we're going to look at some better green shoots second half of the year and still a very stable banking system that is, better funded, better priced, and I think increasingly better reserved.